Hello guys, welcome back to ESENtaxa. Andrea Papetto here, and in this video I'm going to explain you how to pay only 1.2% dividend tax in Italy if you run a business with an Italian company in the Italian territory and you are tax resident in Italy. So stay tuned up to the end of this video because I'm going to explain you this particular structure that you might exploit if you are in certain scenarios and if we found for you a tailored situation for this specific tax optimization. And if you're new in this channel, if it happens to be the first time to watch one of our videos, here in ESENtaxa we talk about how to optimize your taxation if you want to move to a specific country in Europe, and we are the #1 channel that in English language explains everything about the Italian taxation. We go very in details, we found all the possible structure, the optimization that can help you to move to this country and pay less tax possible. Now, we also have introduced an ESENtaxa Academy. You can have a look at it and you basically can understand all about the international taxation matters explained in very easy manner, and also some online courses about some specific Italian real estate tax optimization as well. And of course, if you need a consultancy with us, if you want to understand if your business is suitable for this specific country, for this specific destination, you can have under the description below our calendar link to book a consultation with us. Now, going back to the topic of this video, I said at the beginning of this video that you might pay only 1.2% withholding tax on your dividend. How can it be possible? Italy has a 26% withholding tax. So if you own a company and your company makes some profit and you want to withdraw your dividend, you pay 26%. It's a withholding tax, flat, that's it. Now, how can you get rid of it and how can you just get 1.2%? So let's start from the beginning. This 1.2% actually is coming from a European directive called PEX, the Participation Exemption Directive. So basically, if you have a child company and a parent company, the child company can send and make some, of course the child company makes some profit, can send the dividend, can distribute the dividend towards the parent company with an exemption that in most of European countries it's 100% exemption. It means that the dividends of the child company can flow into the parent company tax-free. Not all European countries apply the 100% exemption. Some countries, such as Italy, apply 95% exemption. What does it mean? It means that only 5% of the dividend income is taxable at the parent level. So the parent level applies the corporate tax only on the 5% of this dividend income. And then if you make the corporate tax at the parent level, which is in Italy 24%, of only 5% of your income, well, it's coming up the famous 1.2%, okay? So the parent company actually, or we're gonna call it holding company, pays a withholding tax of only 1.2%. So this is the way you get the dividend out of your operative and child companies. Now you might tell me, okay, good, you pay 1.2%, but the money still remains in the company. If I'm an individual, then I have to pay other 26% on my parent level, on my holding, in order to withdraw money from my holding company, okay? So it's 1.2 plus 26. So where is the convenience? Now, the convenience of doing so, it's happening only if you change the structure with a different legal framework. And the legal framework I'm talking about is an Italian trust. Yes, an Italian trust. Now, Italy doesn't have the civil law to define a trust. So if you want to use an Italian trust, you have to incorporate a trust abroad in a jurisdiction where the trust has basically designed from the civil law point of view or common law point of view, for example, UK, Malta, Cyprus and other European jurisdictions, and then we need to register the trust in Italy. And this is perfectly possible because the Italian tax agency has designed the taxation around the trust. So if you can incorporate a foreign trust and register this trust in Italy, this trust from taxation point of view become an Italian trust. And then you can add this trust, you can basically use this trust as a holding of your operative companies. So the trust become my holding company, okay? And then everything changes in terms of taxation, because Italy sees a trust, taxes basically a trust with the corporate tax, okay? As long as the trust doesn't specify any beneficiary on his legal framework, so the trust must be an opaque trust, a trust where the beneficiary is not disclosed, okay? So it's discretionary trust normally, also it's called like this. So the beneficiary is not specified, I mean, there is not any specification of when the money has to be given to the beneficiary. There is no specification, any details, who is actually the real beneficiary and when this guy has to get the money. So if there's not specified, this trust is taxed at 24%, okay? Stay with me. So we have a trust that replaces my holding company, okay? And then if this trust works as making, let's say, if it runs a business, so it operates in Italy as a business with an entrepreneur type of income, and if you have followed the channel ESENtaxa, you know exactly what I'm talking about when I say entrepreneur type of income. So subscribe to the channel, notification bell, like button, because you will get notified whenever we release this kind of tax terminologies, helpful concepts, so you can understand better my explanation. So basically, if you run the trust with an entrepreneur type of income, which is basically also is known as commercial trust, basically, then the trust is taxed as 24%, and we can apply the PEX regime on the dividend coming from the operative company. You see? So the operative company is running the business, gives the dividend, makes some profit, gives the dividend towards the trust. The trust is taxed at 24%, but only on the 5% of the profit and not on the entire one. Basically, the trust pays only 1.2% of taxes, okay? So you pay the corporate tax at operative level, and then the dividends only at 1.2%. So the trust pays the 24% only on the 5% of the distributed income, the distributed dividend, okay? I hope I was clear so far, because now comes the real shocking point. Once the money is in the trust, it's not taxed again at the beneficiary level. You see? So basically the beneficiary don't pay any taxes, because since the trust is opaque, is discretionary trust, so this beneficiary is not specified, then we have already taxed the trust at the operative level, at the corporate level, and then there is no dividend tax towards the beneficiary, and that's the reason why you pay only 1.2%. Basically, you pay the corporate tax at the level of your operative companies. Your operative companies make some profit. The trust holds the dividends, holds the shares, receive the dividends, apply the PEX, pays 1.2%, and since the beneficiary are not specified, they don't pay anything. And then basically, you got 1.2% dividend tax. You see? Now, said like this and described like this seems very nice, but there are some nuances, details that must be correctly defined in the contract of the trust, and also the trust has to be considered a dynamic holding company. So the Italian trust, if wants to benefit from both exemption on the beneficiary level and the PEX exemption, at the same time the trust must run a business, make some profit as entrepreneur income, okay, and has to act like not a pure holding company, but has to act like a sort of dynamic holding company. Yeah? So it's a trust dynamic holding company, and this trust allows you to basically have this optimization. It means that a very small amount of stream of income has to be produced as an ordinary stream of income, but then we can analyze this structure, check if in your specific situation this specific structure makes sense for you. So you have to come in consultancy with us, because we can understand if your business makes sense with this structure, if you have multiple stream of incomes coming from different business, so we can pass the business through the trust, another business through the operative company, makes both entities running a business, and then probably this schema could work, you see? So it's very important that we analyze your business and if the business fits with this structure. And if it fits the structure, you can basically live in Italy, be tax resident in Italy, and pay only 1.2% on dividends, basically, okay? Without getting the risk of having a trust abroad, because a lot of clients came to me and they asked me, can I live in Italy, be tax resident in Italy, have my trust abroad? Actually, it's possible, but it's like a very gray area. There are a lot of things that you might need to do in advance before moving to Italy, and at the top of it, you always risk to see in the future your foreign trust requalified as an Italian one, with all the problematic consequences. What if you have everything in Italy with no risk of requalify anything, because everything is already declared in Italy, everything is purely in one single country, and another thing that you're going to avoid is the famous DAC6 directive, European directive, which started from 2024. When you have multiple legal framework, multiple entities in different European jurisdictions, you have to, or your accountant he has to signal or transmit to your tax authorities this structure that potentially be a sort of way of reducing your taxes. So you see, and then you can avoid also this transmission to the tax authority based on this new European directive. You can avoid every kind of unwanted requalification abroad. So you're gonna resolve a lot of problems automatically. I'm gonna release another video on ESENtaxa talking about this DAC6 directive, so stay tuned on ESENtaxa. There are a lot of information and nuances and news that are coming up in this year, in 2025. We are trying to educate you that you're following this channel and try to help you to understand if these things can be avoided, how can you be compliant with all these things without have any problem with tax authorities, not just in Italy, but all of European countries, because this tax directive is an European one. I put so many concepts in this video that I hope you not get confused. Again, in the description below the video you have our calendar link if you want to book a consultation with us, and for anything else, subscribe the channel, notification bell and like button to be always updated whenever we release this kind of video. Bye.